Welcome back. My name's Chris Gosselin from Australian Fund Monitors. We've just seen the end of the half-year reporting season, and what a reporting season it was. Highly volatile, with stocks both rising extensively or falling dramatically. With me here today are Martin Pretty from Equitable Investors and Dean Fergie from Cyan Investment Management. Dean, why don't you kick off and give us an overview?
Yeah, I mean, but the whole theme of AI has been, pretty big in the market for 6 to 12 months. I heard the term AI thousands of times over a reporting season. A lot of hype built into that, and I think that's flowed through to some really elevated valuations, particularly in kind of online and software stocks, and those were the ones that tended to get hammered pretty severely if they didn't meet their elevated expectations. So look across the list. We've seen Seek, SiteMinder, Zip Money, Pro Medicus, Temple and Webster, all kind of online software businesses that had a lot of momentum behind them, had very full valuations, and when those results didn't quite meet expectations, they were severely punished, kind of 15 to 30% falls. And these are billion-dollar businesses, so there was a lot of money wiped off the market pretty quickly. The businesses that did well kind of rose 5 or 10%, so it was a real asymmetrical sort of payoff over a reporting season for certainly a lot of the industrial companies.
So on the downside, it was just a question of reality taking effect.
Yeah, look, I'd agree with that. Like, I looked at some of these businesses and I couldn't even come close to the valuations. And in a way, I felt like a bit stupid. It's like, what am I missing out on? Why am I missing out on these businesses that have gone up, 5 or 10 times in the last couple of years? They've started to fall back to earth a little bit. So, I'd like to think the market is kind of focusing a bit more on fundamentals rather than just, is a company going up in value? That's sort of what I thought the theme was, that there was just this momentum that was completely disconnected from underlying revenues and earnings in a lot of these businesses.
Martin, what's your take on it?
I would be singing from the same song sheet as Dean. 100% agree with everything he said. I think also coming into reporting season, investors ex-resources were kind of on the back foot. You had the kind of SaaS software world and AI exposures being questioned coming into reporting season. I think every single company I listened to spent a lot of time talking about AI, and it wasn't necessarily in a positive frame. It was in defending their position, with the questioning coming in around how AI may be a threat to some businesses. So I actually feel that like that in the ex-resources space was almost a bigger theme than the actual numbers reported, unless you were one of those companies Dean mentioned where the expectations were just way too high, and if they weren't met, it was time, with investors already on the back foot, they were going to react more severely. For everyone else, I think if your numbers were in line, that wasn't enough, because everyone had these other concerns, and most of the earnings calls were about those other concerns.
And it seemed to be across the whole market, and it wasn't just in small cap space.
Yeah, I mean, like I said, if you look at through the ASX top 200, you've got Pro Medicus that was off, like 30%. That was almost $10 billion of market cap wiped off that price. But also, market leaders like CSL, you're talking here a company that was, capped at sort of $85 billion, gave up $15 billion. So there wasn't, this just wasn't sort of a small cap, low liquidity kind of issue. There was serious monetary value being wiped off a number of the larger, mostly industrial stocks on the ASX.
Yeah, so, I mean, I don't think either of you invest in the resources sector, but that was obviously strong specifically on the back of gold and precious metals and that whole electric metals theme. So was this really confined to the industrials area?
Yeah, I think that's a fair call, and I think there's a lot of optimism in the small resources, the explorers. I remember a previous cycle, someone telling me that the small resources stocks should all be valued as real options, and we're probably back into that world again. And I kind of looked at that back then and went, well, you can't have the entire index of small resources all valued as real options. I mean, options come to zero at some point for some of them. And so that's kind of how I look at it now.
Just looking forward, if we've seen the market come back to earth in a lot of areas, particularly in the overpriced industrials, has that finished?
I wouldn't say the fundamental volatility is over. There's obviously clearly a lot of challenges at the moment: the geopolitical, interest rate environment, soft consumer, housing. Those are challenges that will provide risks for some stocks and opportunities for others. I think there's still going to be continued volatility in the market. It's been interesting that there's been a whole bunch of unwinding of the interest in industrials, and that seems to have gone straight into resources. Today we're seeing, massive losses across the board in resources companies. So there seems to be a lot, that sort of flow of money still seems to be moving around quite a bit. What I'm seeing more at the small end is that this volatility is throwing up some, what look to be in the medium term, some really, really attractive valuations on some of these businesses, albeit you need to stomach, ongoing volatility, because it just doesn't seem that's going to end at the moment in the environment we're in.
Dean, you mentioned money flow. Where's this money flow coming from? What's the catalyst for this?
Yeah, it's always hard to kind of get to the bottom of where it all is. I think the ETFs are driving a lot of it, and just when stocks become large, they sort of snowball a little bit. That when they start growing in price, that the index funds have to buy more of them, and it's sort of a little bit of a self-fulfilling prophecy. I also think there's just a lot of fast money out there. Everyone has got an interest in the stock market. It's really easy to trade these days. So I think there's just a lot of, be it from, online forums or, investor clubs or whatever, there's a lot of money sort of trying to find the next big thing. And, every month there are stocks that are rising significantly and falling significantly. So I think seems to be a bit of that, just like bouncing towards the next sort of shiny investment. That would sort of be how I'd broadly look at it. But there's so many actors involved. You've seen massive changes in the funds management industry. Some of those funds losing big mandates and having to sell, which is impacting prices. Hedge funds that seem to do their own thing from month to month. So it's hard to put a finger on it, but that's sort of how I'd broadly look at it.
Martin, what's your view on that?
Yeah, I reckon there's three broad buckets. This is a generalisation, but one bucket is people like Dean and I who are actively invested in businesses and looking for a return from the performance of that business and the valuation recognition of that business over time. There's the indexing, and the more and more data I see, the more convinced I am that indexing has completely changed the market over the last decade, to the detriment of small caps, to the detriment of people with a value bent as well. But there is a chance that maybe we've reached peak indexing. We're seeing the product makers go more into active products. We have seen a rotation internationally in large caps into more value-oriented, less index-weighted alternatives. We're seeing some, I think in the US, the Russell 2000 is the highest performing index of the major indexes over the last 12 months. And then the third bucket, which Dean kind of touched on, is the hot money. And I think there's a pool of investors who are looking for a quick turn. They're looking for what they perceive to be easy money. So we've seen Bitcoin rise and now fall back a bit. The small resources stocks are a source of quick returns and hype and hot money at the moment. So money's pouring into there. And there's a bit of a sentiment, especially I feel amongst the 20 to 30-year-olds, that there is no easy way to make the kind of money you need to fund the lifestyle you aspire to. So maybe speculating, maybe having some high risk bets is a better way to go. So that's the three buckets I kind of see at the moment.
How does this change the way you manage your portfolios?
I mean, for me, I just think it moves the bands around what you think of fair valuation outwards a lot. That if business is out of favour and falling, then it can fall a lot further than what you think is perceived, cheap value. And conversely, if you're in a company that's running and happens to be the flavour of the month, you're likely to let your gains run a little bit further. That's how I look about it. I think that kind of, the band around a true valuation is just a lot wider than it was 5 years ago. I think the punting that's coming in, and Martin touched on it, this Bitcoin is kind of a true sense of absolute speculation, that the world is much more happy to invest in speculative assets, and that's transcended the whole gamut of investment opportunities, that you just have to reflect that this is not a plus 1.5 standard deviation around stock. It's probably moved to 3 or more.
So does this change what you do?
Very much on point with what Dean just said. In terms of what I do, it's changed exactly what Dean just said about the standard of deviations of change you can expect. And we actually plug into our spreadsheets when we're working out how much we can allocate to a stock. Probably much bigger downside gaps than we would have before, because we've just seen that play out over and over again. You may believe in the fundamentals, but in the shorter term, the price can just be completely detached from fundamentals either way. And I still believe fundamentals prove out over time, but you can't pick that time. We can't say when those fundamentals are going to become more important again. It could be in the next few months. It could be still 3 years away. So you've got to be patient. But on the flip side, I feel that if you change your approach, if you are a fundamental-based investor and you invest based on the returns you expect over time, and you suddenly change your approach, you'll probably get caught out.
Would you agree with that?
No, he's a very wise man, Martin. That's why I have some of my investments with Martin. Look, I think just like, it sounds cliche, but like diversification is just increasingly important. If you decide you want to be in miners or gold stocks, then you are going to have periods where you want to shoot the lights out, and you're going to have periods where you're absolutely decimated. I mean, if I want to be in a portfolio of high growth software stocks, I'll have a period where I'm going fantastically well and then terribly, and trying to pick those moments is, I would say, it's genuinely impossible to do it consistently over a moderate period of time. So, we look at it and go, okay, look, we've got some software stocks in there. We've got some like really cheap, fundamentally undervalued industrial companies. We've got some more speculative, early stage businesses. We've got some retailers in there. We've got some finance businesses. Having that overlay across your portfolio of like, you're not going to have everything firing or everything blowing up at once is just increasing performance. If you want to have a balanced portfolio that's giving a good balance between return and risk.
Martin, your comment on that?
Look, I'll add that in the current environment, I've got some very patient investors, of which Dean is one. And I hope that they continue to be patient, because I do believe that in time the fundamentals do play out, and you just cannot pick when. And the moment you start trying to play those games, as Dean said, I think you're going to find yourself missing out on the win that you could have had if you'd been patient, or finding yourself in hot water with something that you didn't understand in the first place.
Gentlemen, thank you. It's always good to speak to you. We'll look forward to speaking again.
Sounds good. Thanks, Chris.
Thanks, Dean.